we're in a world where social media is obviously so present, etc., and we're getting daily updates on what's going on. And it's becoming increasingly difficult, I think, for people to make decisions and make informed analysis about what's going on and where to predict and where to position portfolios.
Welcome to the Walker Crips Podcast. I'm James Richards, Investment Director in the London office.
And I'm Ben Potter, Investment Manager in the York office.
So Ben, let's get into the market update. What's happening in the world at the moment?
It's a great question, and it's ever changing, isn't it? I mean, it's been a very, very volatile year, is what we're hearing and having conversations with clients, as I'm sure everyone's been reading about in the news. Biggest thing that I've been speaking about at the minute is AI, artificial intelligence, for anyone who doesn't know that. Conversations are still directly being led by AI and its influence on markets. And I think it's such an important topic that is still ongoing. I mean, we're seeing such large capital expenditures across the world, particularly in the US. And all of these businesses are seeing phenomenal returns, and it's been a different type of market environment, hasn't it? But this year we've seen geopolitics, conflicts, all this sorts of stuff, which has had kind of a bit of an impact on markets, but generally they've been held up pretty resiliently.
Surprisingly so, I'd say. I think markets seem to sadly have forgotten there's a war in Europe.
Yeah.
Clearly, the Strait of Hormuz is the big issue, and with the oil price, which we can get into in a bit more detail later, that's had a big impact. But markets have continued to rally for the majority of the first half of the year, even with a war going on in the Middle East, American soil being attacked overseas, and Iranian bridges and infrastructure recently.
Yeah, and I completely agree. It seems to have had a bit of a disconnect in terms of what's actually going on in the world. And I think that's largely because of how much noise there's been surrounding it all. I mean, we're in a world where social media is obviously so present, etc., and we're getting daily updates on what's going on. And it's becoming increasingly difficult, I think, for people to make decisions and make informed analysis about what's going on and where to predict and where to position portfolios, which I think ultimately has led to a bit of a change in market dynamics and where people are positioning things. So it's such an interesting time to be in. I mean, we started this year, didn't we, with Trump coming in, making all the announcements that he was doing in terms of the war with Iran. He was going to, I mean, I think back in February, March time, I'd listened to a story or read some research that he was going to end the war. And I think we were up to 47 times that he'd said that already. Dread to think what that number is now, by the way. But we've heard so much about it. Oil prices, which you mentioned earlier, I mean, they got over $100 a barrel quite comfortably, pulled back a bit. Now they're back over $80 a barrel. All of this has impact in the supply chains, the businesses that are investable, and it also changes investors' inflation and interest rate expectations. So I think there's been a lot to unpick in that, and it's been very difficult. But how have you found it in terms of conversations with clients, etc.?
Inflation is the biggest key, I think, for me, is the oil price. I tend not to invest in commodities, and we can talk about that, but one can't avoid commodities because of the second and third order effects that they have on the market and inflation. And we're seeing that in the UK and Europe and America. So trying to buy companies that are resilient, that have good, strong profit margins, that can deal with inflation. Either they can absorb some of that and not have to increase their prices, or some companies, we think of tobacco traditionally, is able to pass on price inelastic, because their clients, their customers will pay whatever price for it. And so from an investment point of view, it's trying to focus on, are those the right companies they have been in the past? Are they still today? And then thinking about AI.
I think it's such an important point, and I think you're spot on in everything there. But the AI comment is really interesting now as well, because we've been through, haven't we, over the past few years, it's been all talk about AI, and we've seen all the technology stocks, obviously not all of them, but lots of them making the news headlines and the phenomenal returns. I mean, who can argue with that with Nvidia? You look at that growth and it's been phenomenal. The earnings growth of that business has been so impressive. The question now, I think a lot of investors are beginning to say is, how long does it go on for? What are the actual bottom line impacts of this AI? We hear lots about the efficiencies that it's doing, and lots of us are implementing it within our workflows, within our daily tasks, within businesses on a bigger scale, which is great, but what's the actual net impact on margins? And I think we're yet to see a material upgrade in that quite now, is probably fair to say. yes, of course, we're seeing some improvements, but I think there's a lot of people who are still thinking maybe we are in a little bit of a valuations are maybe a little bit overstretched in this regard now. And what I've noticed in research is value stocks, which, like you mentioned a bit more there, like cash generative businesses with tobacco who can pass on the cost to customers, etc. They're looking to have kind of generated a lot more returns over the past year to date sort of figures. So I think there is a bit of an investor sentiment change and rotation in portfolios from growth into value. Are you seeing the same?
I am. I think lots of clients and fund managers that we speak to are concerned that there could be this AI bubble. Certainly not calling the top of the market today, but I do think I'm conscious of it and trying not to be overly exposed to it, but equally aware that we're not in a dot-com situation, the dot-com bubble in 2000, because a lot of this expansion that we're seeing from the hyperscalers, the Microsofts, Amazons, and Apples of the world, it's funded by free cash flow.
Yeah.
And so there is profit behind it, and it's not just sort of finger in the air, speculative spending raised from debt. So I'm more comfortable with that than I would have been 25 years ago.
I completely agree. And whenever you look back through the statistics and look at the numbers from back in the 2007, the great financial crisis, it seemed to be funded by debt, didn't it? Lots of it. And as you alluded to, we are in such a different situation there where the free cash flows of these businesses are supporting the capital expenditures that they're doing. I think the key impact now is just where is that actual efficiencies and where are the margin improvements going to be across businesses? And that's still an ongoing debate, isn't it? I mean, we of course speak to loads of different people on a daily basis through our jobs, whether that's fund managers, whether that's clients who are all in various industries. But one area that I kind of see that, I mean, we in professional services do it, don't we, in terms of how do we analyse data? I mean, you look at, I recently spoke to a legal company, for example, and they're saying that they're using lots of AI to help them read the particulars, scan through cases a bit more, and kind of get you to that 80%, like almost 80% of the work, and then you need the specialists to kind of finish the rest, which if it does that, that's a great margin improvement, isn't it? But then I also hear to the contrary that the AI then creates more questions, which ultimately creates more work. So there's still a debate on either side, isn't there? And it's still finding its feet, but I think it's important not to be over-allocated to AI. And that kind of comes into a lot of what we do, isn't it, on a day-to-day basis in portfolio construction.
Diversifying portfolios, exactly. Both within equities, shares of companies in the AI space versus non, and also other asset classes.
Yeah.
Gold's a hot topic. It's had a fantastic run over the last 2 or 3 years. How are your thoughts on it in 2026?
You said something earlier that you're not heavily exposed to commodities, and on a generalised basis, I've kind of taken that view as well. Now, I think where inflation, obviously we had kind of 2022, COVID, where interest rates were near zero, inflation was very low, below target, etc., for a long period of time. We've then gone into a different type of environment where inflation has been very impactful. It's been a lot higher than what we've been used to over the previous decade before inflation started coming through. And we've then seen a re-rating in interest rates, ultimately, to try and calm inflation. And that's been very positive for the gold price, and which has often been a bit of a hedge against inflation, which has been the narrative that everyone learns about, etc. And I think that's still true. But what I do think now is that we're hopefully, I mean, who knows where it's going to go, but what we're reading about now is that we're kind of out of the worst of this inflation uplift, and it's kind of starting to settle with interest rates being a bit higher. And we should hopefully start to see interest rates coming down a little bit more, is the general thought. And I kind of, in broadly speaking, think that's a sensible base case. How long will that happen? How long will that be? I don't know. We don't know on that. And there's lots of things that will impact those figures. So we'll have to wait and see how that unfolds. I think gold has a very important place within portfolios for a lot of people, for a lot of investors. And I think it acting as a hedge against inflation is a good thing. And obviously they've had a lot of good returns from that over the past year or so. But I also think it's important not to get too overexposed. I mean, we have seen a pullback. You've had a lot of profits recently. It's probably worthwhile, a lot of people taking profits and looking at where else to allocate. What are your investment aims and objectives in that? And do you want to have, maybe you had 5% in gold to begin with, maybe it's now 10, 11%, depends obviously when you got in, etc., and all that sort of stuff. But I think it's having a look at that allocation and consistently reviewing your position sizing and taking profits along the way when it has performed well. But what about yourself? Do you hold much gold? What are your views on it?
I do. I see gold separately to commodities. I think of it on its own, and I agree completely with your views on as an inflation hedge. But I also like it just as a diversifier, a pure diversifier. It's not in the long term negatively correlated to equities. It's uncorrelated, so it's running its own race, and that's why I like it. We often we have lots of phrases in the investment industry, but we say when there's blood on the streets, people tend to put money under the mattress or they buy gold. And so I like to always have a bit of gold, maybe 5% in a portfolio as that ultimate hedge.
Yeah, and I think that's a very sensible approach, isn't it? Especially for the certain clients that it kind of fits that bill for. But yeah, it's certainly an important consideration within portfolios, and it can be very helpful, can't it? But there are lots of other asset classes as well, which is important to note that can have a bit of that impact as well, which you talked about, the uncorrelated returns to equities, which is another big component. And there's not just is there like gold, commodities, equities. Fixed interest has been an important topic over the past year or so.
Absolutely.
Which is what I think. And as a result of the interest rates going up, we've seen suddenly fixed interest again is offering attractive yields and attractive returns. I mean, we can get from government bonds relatively short dated, which are historically and typically relatively low risk. You can get those for about 4% yields, which for a lot of investors who have generated a lot of wealth over the past few years, because we've had good equity markets, it's worth considering. And I know I've been doing it across my portfolios, and I've been taking some profits from certain equity exposures and trying to allocate it to fixed interest as almost a wealth preservation tactical move. And then if we see a pullback, I know I've got some stability within the portfolio that I can add to equities at maybe a more attractive valuation.
Almost like a dry powder part of the portfolio.
It's exactly that in my view, James, yeah.
I've seen a lot of that as well, particularly with clients for UK government bonds, or gilts as they're known. There's the added quirk that they are capital gains tax exempt. And so for some clients, that 4% yield that we just talked about on short duration gilts is equivalent to something like 6 or 7% of interest at the bank, which would have been taxed at someone's 45% rate. So it can be really attractive for additional rate taxpayers.
It's such an important and a conversation that we're having more and more with those types of investors. And of course, when you're a higher rate, additional rate taxpayer, the impact of that can be quite substantial. And it's when you see clients with large cash balances in those regards, and they are paying tax on their interest, it can be a really useful tool, which is a slight little tweak, but it can have a big impact on large cash balances. So it's certainly an important factor and important to consider within your wealth journey, investing journey in a way, in how to kind of maximise your returns. So yeah, I think gilts and that narrative is likely to continue, especially with where we're at now. If you look at global valuations, they are elevated at the minute, which is largely driven by the US, because the reasoning behind that isn't there. There's good reason. These equities have performed exceptionally well on an earnings growth basis. So would you pay a premium for that earnings growth? Yes, a lot of people have, and a lot of people continue to do so. But I think when you zoom out a little bit, you kind of look at the historical returns at these price to earnings level as a basic level of valuation, if we look at it on that basis. If you look at a one year kind of scatter graph of where the returns would be buying in at let's say an average of 23 times price to earnings ratio, something like that. If you were to buy at that, 1 year returns, it could almost be anywhere, is kind of what the data tells us. Whereas if you look at 5 year returns after that level, it significantly reduces your chance of delivering outperformance. So I think it's important to have a bit of dry powder within portfolios, as we call it, which just means a bit of a stabilizer. And therefore, if there is a bit of a market correction, a bit of a market downturn, you can pivot those assets at better valuations, which over a longer term period, which is what we try and achieve, you should, in theory, over data from historical figures, be able to generate more alpha that way. But yeah, I think valuations are important right now.
Absolutely. Well, thank you very much for listening in, and hope to see you next time.